Today, we're diving into a detailed analysis of SoFi Technologies, the fintech giant that many believe Wall Street has misjudged. We will be examining why the consensus is bearish on SoFi, despite its strong financial performance, and I'll share my long-term outlook for the stock.
Hello, everyone.
Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell, so you never miss any of our uploads and also enter our giveaway. But before that, alert, this is not a financial advice video. For those who might not be familiar, SoFi Technologies is a financial technology company that operates primarily as a digital bank. Their highly intuitive app offers consumers a wide array of financial services and products, all accessible from the convenience of their mobile devices. Recently, SoFi Technologies, which trades under the ticker symbol SoFi, has had some positive news. Despite this, their stock price continues to decline. This downward trend persists even though the company has surpassed its quarterly earnings estimates. One major factor contributing to this bearish sentiment is the high level of short interest in SoFi. Currently, 76% of SoFi shares are sold short, indicating that a significant number of investors are betting against the company's stock price rising. This short interest is one of the reasons why many on Wall Street predict further declines for SoFi's stock. However, I believe that this negative outlook is misguided. Let's delve into the reasons why. When examining SoFi's financials, the company appears to be performing quite well. Their GAAP earnings per share EPS came in at $0.02, doubling the forecasted $0.01 per share. This represents a 100% beat, which is excellent news. Additionally, SoFi reported net revenues of $565 million, surpassing analyst consensus estimates. On top of these strong results, SoFi has slightly raised its full-year revenue and earnings guidance. Despite these positive financial results, the market's reaction has been lukewarm at best. The issue lies in investor expectations. Many investors have unrealistic expectations for SoFi, leading to disappointment even when the company performs well. This disconnect between performance and expectations has contributed to the stock's downward trend. Essentially, even if SoFi continues to deliver solid results, it may still fall short of what investors are hoping for, perpetuating a bearish outlook. Not all analysts share this pessimistic view. Dan Dola from Mizuho has been notably bullish on SoFi. He recently reiterated his positive stance, setting a price target of $12 per share within the next 12 months. Currently, SoFi's stock trades between $6 and $7 per share, so reaching $12 would represent a significant gain for shareholders. Dola's optimism is based on the belief that SoFi is well-positioned for long-term growth, despite current macroeconomic challenges. SoFi's lending growth may not be spectacular at the moment, but it is expected to improve as macroeconomic conditions change. The company's business model is robust, with above-average growth rates in their various financial services. If they can maintain this growth trajectory, SoFi could see substantial gains in the coming years. A key aspect for investors to watch is SoFi's profitability. Incremental revenue growth should translate into better earnings per share EPS. Even the bearish analysts project significant EPS growth for SoFi. They forecast that next year's EPS could reach $23 per share, which is nearly triple the current EPS. Looking further ahead, projections for 2025 suggest an EPS of $36 per share. Given that SoFi recently reported a positive EPS of $0.02 for the latest quarter, this indicates a strong growth potential. If SoFi can achieve $36 per share annually, this would be a remarkable increase from their current performance. One concern for potential investors is SoFi's current valuation. The stock is trading at 88.3 times its forward earnings, which might seem high. However, analysts believe this metric will decrease as earnings grow. If SoFi's EPS can scale up to $1 per share in the coming years, their forward earnings multiple will drop significantly, making the stock a more attractive investment. This potential for earnings growth underpins the bullish case for SoFi reaching $12 per share, as suggested by the Mizuho analyst. From my perspective, SoFi Technologies is a strong company with promising long-term prospects. While I may not fully agree with the $12 price target, I do believe that SoFi stock is likely to be worth more in the future than it is today. This implies that now could be a good time to consider adding SoFi to your portfolio, especially if you have a long-term investment horizon. In summary, despite the current bearish sentiment and high short interest, SoFi Technologies presents a compelling investment case based on its strong financial performance and growth potential. Investor expectations may currently be too high, but as the company continues to grow and improve its profitability, the stock price should eventually reflect these positive developments. With analysts like Dan Dolev providing a bullish outlook and setting ambitious price targets, SoFi could be a worthwhile addition to any growth-oriented investment portfolio. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.